Hi everyone, and welcome to our 8th installment of Who Moved My Investment Portfolio. Today, I'm with my colleague and fellow portfolio manager, Dharit.
Hello. Thanks for having me. Can you believe we are already halfway through 2024?
Yeah, time has really flown by.
Since we are in the middle of this year, should we start with a market review?
There's just what I had in mind. I see great minds think alike. Much like in last year, the first half was defined by the US Federal Reserve's interest rate policy.
Absolutely. With inflation starting to show signs of easing, we started 2024 with much optimism as market expectations were 6 to 7 cuts across the year. Much has changed, with 2 anticipated rate cuts for the rest of this year, a marked departure from earlier. Why is that, Robin?
The Fed has listed several reasons for this, ranging from the danger of cutting rates too quickly to concerns over demand being stronger than assessed.
Sounds like the Fed is basically implying that it is in no hurry to ease monetary policy.
That's right. For the Fed to feel confident to cut rates, 2 things must happen. Consumption slows and inflation moderates further.
Another way to look at it is the resilience of the US labor market has kept consumption strong despite interest rates being relatively high.
Yeah, that sounds about right, Dharit. After all, US retail sales data continues to exceed expectations as consumers power the economy on the back of record low unemployment.
After a knee-jerk pullback in April, the S&P 500 has spent the past couple of months at record highs.
For bonds, the reduction of rate cut expectations from the start of the year has weighed on the asset class. However, the higher yields have by and large compensated for it.
Indeed, investment-grade bonds now offer yields above 5%, a level not seen in over a decade. Let's address markets close to home. How would you summarize what we have seen in Asia this year?
Asia bonds have outpaced global bond markets, and Asian equities continued its 2024 revival and are up 9% on a year-to-date basis. This was underpinned by strong returns from markets like Taiwan, India and China. Now we expect Asia's outperformance to continue into the second half of this year.
Well, Robin, I'm glad you brought that up because that's a great time to segue into our views on equities. Would you like to take us through?
Sure. Like what we just touched on, the US economy remains strong, with earnings growth expected to hit 10.5% this year and 13% next year. Now to top that off, in the latest reporting season, earnings surprise came at 80%, driven by strong momentum in technology, consumer and healthcare. Now we expect US equities to stay resilient amid greedflation and robust earnings outlook.
Asia ex-Japan equities have been a positive this year, supported by policy measures in China, AI beneficiaries in Taiwan and South Korea, and growth prospects in India.
After a sluggish and laggard performance over the past 2 years, our view is that China has turned the corner. Now in the second quarter of this year, China continued trending upwards on continued policy support, such as the recent slew of property measures.
Other than this, we expect China equities to benefit from shareholder-friendly corporate initiatives as well as commitment to capital management.
That's right. And even with the positive returns we have seen year to date, the valuation of China's stocks are not demanding. Now, should we expect broader Asian equities to perform?
We believe so. China is a leader in Asia's growth engine. However, we also see positive factors like quality corporate balance sheets, improving cash flows, and positive earnings outlook for other Asian economies. And hence we maintain an overweight view on Asia. Over to bonds. Now Robin, expectations have changed since the start of this year. Should investors be positioned for a higher for longer environment?
For starters, stay in high-quality investment-grade bonds, especially with bond yields at current levels of over 5%. For savvy investors, our view is that the sweet spot remains in the single A and triple B credit rating region. In this environment, investors should consider a duration barbell with one sleeve of bonds in the 1 to 3 year duration range and another in the 7 to 10 year range. Now the 1 to 3 year sleeve serves to not just capture the high absolute yields, but also the benefit from the turn of the rate hiking cycle. Since short-end rates are the most impacted once rate cuts ensue, this is the segment that stands to gain with more certainty from a repricing. Now, it can be expressed through short-duration unit trusts or within DigiPortfolio, the Save Up portfolio.
On the other hand, the 7 to 10 year sleeve offers investors the opportunity to benefit from wider spreads as well as the benefit from higher bond prices should the rate cutting cycle materialize.
As we approach the peak of this economic cycle, we continue to hold a preference for bonds over equities within a diversified portfolio.
That's right. Hope you found today's update useful for your financial planning journey. Also, do check out DBS's newly launched 4 Money Habits to get you from your first paycheck to your retirement.
Thanks for chatting, Dharit, and thanks for watching. If you enjoyed this video, please like, share and subscribe to our channel for more updates. And don't forget to hit the bell icon to get notified about our latest videos. See you next time on Who'll Move My Investment Portfolio.
Bye.
Bye.
Stay updated with weekly insights from DBS.